The Reserve Bank continue their path back to a more neutral official cash rate, but with increasing urgency. Our latest forecasts for domestic and global markets. The back-to-back 0.5% RBA rate hikes mean official rates have now risen 1.25% in 3 months, the sharpest quarterly increase since 1994, reflecting the commitment from the Reserve Bank to proactively manage inflationary risks and not allow inflation expectations to become unanchored. While this only returns interest rates to around the level they were at in 2017, the pace of the rate hikes is impacting consumer confidence and property markets, as the RBA attempt to slow down the economy and dampen demand to better match the lack of supply in the economy. Despite the promise of more RBA hikes, with another 50 basis points still very likely in August, before the increments perhaps step down to 0.25% per month, retail sales have maintained their strong trend, so household demand is yet to be impacted. And the causes of the inflationary shock, rising energy costs, supply chain disruptions from overseas, and locally the devastating floods, appear likely to be with us for some time. Just how aggressive the RBA will need to be to have any impact on inflation by reducing demand is a critical unknown. And equally important will be how well our economy can withstand higher interest rates and adjust by decelerating rather than going backwards into recession. Recession risks in North Atlantic countries are very high, with the US yield curve again inverting this week, which, as we highlighted in our April update, is a worrying sign for a 2023 US recession. But here, there are a few factors that make a soft landing for our economy more likely. Our jobs market has never seen these levels of job vacancies before, with almost a third of employing businesses unable to find suitable staff. So demand for labour has helped the unemployment rate below 4%, and underemployment, pleasingly, is well below 6%, its lowest level since 2008. Typically, recessions would occur with a sharp fall in employment. So, as our economy slows in 2023 in the face of higher interest rates, it will be important that demand for labour also achieves a soft landing. We still expect unemployment to dip to 3.5%, but now expect it to edge back up into the 4s next year. Other factors supporting our economy include the resumption of international tourism and our strong trade surplus. But the slowing global economy is seeing an easing in commodity prices, and volatility in financial markets is ever present. As a result, the Aussie dollar has fallen back below 70 US cents, and the US dollar index is up to a 20-year high. The last time the greenback was this strong, the Aussie was down at 55 US cents. So, the long-awaited support for the Australian dollar on the back of firm commodity prices is only providing relative strength, not a new uptrend just yet. In short, our economy is adjusting to higher interest rates, with an official cash rate of around 2.5% likely by November, and asset prices will continue to adjust to more neutral policy settings. But while North American and European economies face sharply lower growth rates, here, high household savings levels and lower inflation rates in many of our trade partners offer the opportunity for our resilient economy to once again cope with these global challenges. Our next inflation data is out on July 27th, which will have a critical impact on RBA interest rates and their next set of forecasts out in early August. And that's the market update from Bendigo Bank.